Hi, this is a quick recap on the first finance session. Are we financially compliant? Um, we looked very briefly at the key compliance requirements of filing annual accounts, keeping simple records, the very basics around tax, touched on director and trustee duties, and looked at some everyday good practice. We recognise that this isn't an advice session, and the invitation was always go back to the primary guidance and get proper professional advice. And I think having a professional advisor in the mix is a really sound investment. We looked at the fact that finance is a cycle. We start off with a budget, and then we need some bookkeeping and controls, a cash flow forecast. Then we review all of that in the monthly finance pack, see if we need to take any corrective action. We get to year end and we put the bookkeeping data in the annual accounts, and then we do a longer term review by looking at our reserves and resilience. And all of that is underpinned by good financial governance. And that's compliance are the boxes around the centre, how we implement it, but it starts in the middle with having those compliance behaviours bedded in. And there are lots of reasons to bother. It's a bit of a faff, but so quite good to get motivated to do it. I think it's really trust building because it really helps us stay funding ready. If you look at the Charity Commission register, Companies House register, when there are late filings, it can be off-putting, and it can show that things aren't always as under control as maybe they could be. So it can really help with fundraising, and it helps us keep within the regulatory guidance and framework. And sometimes if you step outside it, you can risk, fines or reputational damage. And if you're in a leadership role, because compliance is such an important duty, it can be quite stressful when you're not feeling confident. But ultimately, really, what it does is the first step in keeping the lights on and keeping the show on. So the first step is to be familiar with your legal structure, because there are different rules for different structures. So you know whether you're a charity, community interest company, limited by guarantee or by shares, or a sole trader, helps because that will determine your primary regulator, which might be the Charity Commission for England and Wales, or Companies House, or the KIC register. Or if you're a sole trader, it's probably HMRC. We need to think then within that context, what are we doing for our annual accounts? What do we need to do? Compliance is knowing what you need to do and then showing that you're doing it. So what do you need to do from an accounts point of view, from a governance point of view, for tax, and keeping that primary regulator up to date. And all of that is underpinned by really good record keeping. So very briefly, all charities need to keep accounts, and all registered charities need to prepare a trustee's annual report. And if our income is, if we're a charitable incorporated organisation, a CIO, then all of us file annual accounts and reports. If we're not, but we are a registered charity, and you can be a registered charity without being a charitable incorporated organisation, then, and your income's over 25,000, then you file your accounts. And when we're talking about filing accounts, it's putting them on the Charity Commission register. The type of accounts that we prepare varies. If we're smaller and we're not a company and our income's under 250,000 a year, we can prepare a simple version of accounts, which are receipts and payments accounts. These are cash accounts, what's come in, what's gone out. If we are larger than 250 a year, and if we're small and a charitable company, then we must prepare accruals accounts, and these need to be compliant with the charity's statement of recommended practice, the accounting rulebook for charities. We also need to have our accounts independently verified. Small charities can have an independent examination. Larger charities need to have a full audit. And then when we file our annual accounts, we are filing them with the annual return, which is a form that we fill in and rekey a lot of the data from the annual accounts, and then that populates our Charity Commission register. And all charities need to file one where their income is over £10,000, and smaller organisations have a bit of a lighter touch annual return requirement. And you should know that the charities sought, the accounting rulebook and the reporting and filing thresholds are changing. So make sure you are signed up to the Charity Commission for their alerts. Ideally, you'll have an accountant or an independent examiner in the mix who's going to keep you up to date as well. If you're unsure what to prepare, the link on the left will take you to a diagnostic. You put in your organisational type and annual income, and it will tell you. The link on the right is where you go to file your annual return, and certainly for the second one you will need a login, so make sure that's securely stored somewhere. This is an example of charity SORP accounts. You can see that they have lots of data on them. On the right hand side we have the statement of financial activities, which is the income and expenditure account, and the thing to note here is the funds. So there are 3 columns generally for every organisation if you have restricted and unrestricted funds, and we'll look at that briefly in a minute. So if you have any restricted grants, you'll have restricted funds, and so you need to keep those separate in your accounting. On the left hand side we have a balance sheet also for a small charity, and we don't go into those in detail in this session, but we will in upcoming sessions. Very small companies, which are micro entities, that means having a turnover of 1 million or less and a balance sheet of £500,000 or less and 10 employees or less, can prepare much simpler accounts and need only currently, this is true, but again this is changing also, send the balance sheet to Companies House. And the micro accounts look like this, so as you can see they're a lot simpler than charity accounts, and I think that's the case throughout compliance. That compliance bar is much higher for charities than it is for companies, and KICs are somewhere in the middle. Very small companies, so if you're not micro, if your income's over 1 million or your asset base over 500 or your team is over 10, then you might be small, and so that would be anything up to 15 million once you're over the 1 million. A slightly higher balance sheet and up to 50 employees. And if you're small, your accounts don't need to be audited. They do need to be a bit fuller than the micro accounts, and you choose whether or not to send a copy of the director's report and company and profit and loss to Companies House. You can send abridged accounts and just focus on the balance sheet, but again you will speak to your accountant to make sure that it's compliant with whatever is in your constitution and the prevailing regulatory framework, which, as I say, is changing. And the link on the left here will take you to filing your company accounts and gives you a bit of a sense there of when they're due, generally 9 months from year end. Unless it's year 1, then it'll be 21 months after year end, and the tax return is 12 months after your accounting period for corporation tax ends. And again, it's a really good idea to have an accountant who's going to firm up these dates for you. You write them down put them in your diary, all your compliance requirements, and then you never miss a deadline. The link on the right is where you click when you actually want to go and file your accounts, and again you need to log in, so make sure that's somewhere. Companies House is bringing in verification, identification, which is a new requirement, and so all company directors now need to verify their identity. It's pretty simple if you've got a passport. Might be less simple if you don't have that new passport with the chip, but there are other forms of identification that are accepted, and there you go to Companies House, Google Companies House identify verification, and it will give you chapter and verse, and I would do that early so that you're not caught out at the last minute. Corporation tax is a tax on trading profits in an accounting period, which is generally 12 months, but year 1 might be longer or shorter, and the amount you pay depends on how much profit you make, and there are allowances and reliefs, and again you need to really talk to a proper professional advisor to get a really high confidence corporation tax return at the end of each year, so you're not under or overpaying your tax. Charities generally do not pay corporation tax. Sometimes we have a trading subsidiary and there are rules that apply in order not to pay that corporation tax. Again, you would speak to your independent examiner. Charities are sometimes sent as random return, not often, and we normally respond with a nil return, but again, seek advice. Charities do pay PAYE when they employ people, and they do pay VAT, so it's not true that charities pay no tax, and they can claim gift aid tax back on qualifying donations. Charities can also get VAT reduced on fuel and reductions in business rates. Again, if you Google HMRC tax and charities, it will give you chapter and verse. So we now know that we have to file accounts, keep tax records, and in order to make that really smooth, we want really good record keeping in the year. And so, well, essentially you need a bookkeeping system, and that's going to record all of your not banking transactions, as it says there, Freudian slip, your banking transactions. And from that, you can then prepare a profit and loss report if you're a company, or an income and expenditure report if you're a charity, and a balance sheet. And if you've got any restricted grants in the mix, ideally you want your bookkeeping system to do as much of the heavy lifting as possible. What we're really looking to do is make sure that we're tracking funds. Not all money is equal. Some comes in and it's restricted to a particular purpose. So restricted funds can only be spent in line with donor intentions. Unrestricted funds can be spent on anything, and designated funds are unrestricted funds that we have ring fenced for a particular purpose. It's jam jar accounting, and we need to be able to track them all separately. And so this is taken from the charity sort, the accounting rule book, and sets out the funds tree. And as you can see on the left hand side, you've got your unrestricted funds, which are either designated for a particular purpose, or, and if they're not, they're all in the general pot. On the right hand side, we have restricted funds, which either comes in and out as revenue or is a capital sum that you are allowed to sit on. Reserves, that rainy day fund that you've probably heard so much about, and which every funder wants to know about if you're applying for grants, only come from unrestricted funds, because everything else, all our restricted funds, are restricted to particular purposes. It's only our unrestricted funds that we can use for anything. It is only the freely available bit of our unrestricted funds that are available, and we look at reserves in a later session. Again, if you look in Charity SORP and look at reserves, it will tell you the detail on this, but essentially, in summary, reserves are unrestricted funds after we have deducted any fixed assets that we use to deliver our mission and any designated funds. It is only unrestricted funds that are freely available. It's basically the cash bit. And so we want our bookkeeping system to keep track of all of our funds and reserves. Otherwise, it gets into this horrible Gordian knot that can be really difficult to unpick. And in Xero, you can do that by just using tracking options. And for every transaction, you say it relates to this grant or it relates to our central funds. And in QuickBooks, you customize what's called classes. And again, you can track every individual transaction. The bookkeeping system could be done in Excel. Works really well in Excel, up to about 2 or 3 funded grants. Then it gets a bit cumbersome. You could go for a free app like Wave or Quickfile. As long as they do funds, that works. Not all of the free ones allow you to track different transactions to different projects or fund grants. And we generally recommend it in Embrace Finance, QuickBooks. Xero's okay, QuickBooks is excellent for fund accounting. And so for each transaction, what we're recording is money in, bank receipts, sales invoices, money out, any direct debits or standing orders, any bills. Essentially, you're recording everything that goes in and out of your bank account. And you also might have non-cash adjustments like depreciation. And so having a really good bookkeeper in the mix is probably quite helpful. For each transaction, you want to capture when it came in or out, who it was from, why, and attach any paperwork, which you can do easily in Xero or QuickBooks. And in Excel or Google Sheets, you'll just have a good referencing system. When we're thinking about what paperwork we need, essentially you need a paperwork trail for every financial transaction, whether it's receipts and invoices, any bank statements, gift aid records, payroll records, VAT returns, etc., etc. And we keep it all for at least 6 years or longer if our constitution requires. This is an example of an Excel cash book, an Excel bookkeeping system. And so on the left hand side with the purple bit, headed bit, that's where we track our banking. It is literally a list of everything that comes in and everything that goes out. It mirrors our bank account with the running bank balance. On the right hand side, it categorises all of those banking transactions into the relevant grant or into the general pot. The data on the left hand side should be the same as the data on the right hand side, because we are simply noting the transaction coming in or out and then allocating it to the relevant grant. You can customize the cash book, and there will be a copy on the website, so that at the top it captures the total in each column, the total income that's come in for grant 1, for example, and the total expenditure that's gone out for grant 1. And then you can get an income and expenditure summary report, grant by grant, with unrestricted funds all neatly side by side, plus the total. And what we're aiming for, whether we're using Excel, Google Sheets, or an accounting system, is to be able to prepare and understand our monthly and annual income and expenditure reports and balance sheet. And it's the annual versions that we file at year end. All of this is the duty of charity trustees or company directors, and you can see here with links the list of duties for each, and they are broadly the same. As trustees, we have to manage resources responsibly and act with reasonable care and skill. As company directors, we have to exercise reasonable care, skills and diligence and not misuse property. So they are broadly similar. And if you're unsure, you'll go and look them up and see exactly what you need to do. There are long guidance notes, certainly on the Charity Commission. Either way, whether you're a charity trustee or a company director, we are being very mindful of the fact that we have a going concern consideration. This means that when we sign off our accounts, we are proactively stating that we have done the assessment and the charity is a going concern. This is an accounting term that means that we are able to meet bills as they pay full due for the foreseeable future. And so when we're signing off the accounts, what we're saying is we have made an assessment, we have looked forward, we are confident the charity is a going concern, and we have considered all the available information, our starting point from our annual accounts, our future budgets, our future cash flow forecasts and scenarios, and we are confident that when we sign off the accounts, we can keep paying bills as they fall due for the next 12 months. We can cover off a lot of this with a cash flow forecast. In this example, the charity has 18,400 in, 11,800 out. It's making a surplus of 6,600. Yet when we see at the bottom, when we add in its opening cash balance and its closing cash balance, although it is budgeting to turn a profit of 6,600, it is starting in January with an opening cash balance of just £1,000. This means that it will not have positive cash balances until its grant comes in June. If it does not have an overdraft, the bank simply will not pay all of those payments that it has scheduled for rent, accountancy fees, insurance and heat and light. And so it's not sufficient simply just to have a budget. It's also necessary to have a cash flow forecast and make sure that the budget is coming in before the budget is going out. So we've done a very short whistle-stop tour through our compliance requirements and how we might start to manage them. We will look at these more as we go through the rest of the sessions. The biggest barrier to financial compliance and financial resilience is not actually technical. If you need a set of books or a set of accounts, get an accountant. The biggest barrier by far is attitudinal, it's behavioural. People, for very valid reasons, find finance boring, difficult or anxiety provoking. There are lots and lots of barriers to good governance. We all do them and we all need to work hard not to do them. the most common ones here from the Corporate Governance Institute is that the organisation just can't make decisions. For whatever reason, it's stuck. Don't be stuck. Unstuck yourselves. There's no challenge. Everyone's agreeing all the time. There should be a little bit of friction. And this is when you're taking big decisions as a board, that actually everything's already been decided before you get in the boardroom, or the board is very focused on the day to day and not focusing on the big picture, and no one actually turns up. There's no engagement with the organisation. When it comes to compliance, you need to be able to take decisions. You need to be able to challenge if you feel someone is taking a non-compliant action or course of actions. All trustees are jointly and collectively responsible, and all company directors. You may have a person with significant control if you're in a company director, but being able to challenge and know that the decisions being taken in the meeting are the primary decisions. There isn't you're not just a shadow board going through the motions, is important. Compliance is often looking at the big picture, knowing what we need to do in relation to external regulators. It's not always focusing down on the minutiae. And if no one ever turns up, or if no one is engaged, that's quite a significant compliance risk. So you want people on your board who are engaged. This list comes from Margaret Heffernan's book Willful Blindness, which I rather like. She says that the common barriers to good governance are, conformity, we all agree, obedience, we all defer to the chair or the treasurer, the bystander effect. If someone thought there was a problem or we're going to be late, someone would have mentioned it. Distance, we're too distant as trustees or directors to really know what's going on, and we just don't like to talk about money. All of these play out in all of us, or most of these play out in most of us, and I guess it's being aware when it's playing out in us and in our governance, and finding ways to challenge that and not let it get in the way of good financial decision making, which is acting within your powers, acting in good faith, only in the interests of the charity or CIC, making sure you're sufficiently informed, taking account of all relevant factors, making sure that the finances are firmly in the mix. And so the recommendations for today from this very brief session is compliance is important. It underpins everything. You can't make social change happen without it. It's really dull. It just needs to be done. It's not rocket science. There are people out there who do it in their sleep. I would get one of them. I would get a good accountant who knows your sector. If you're a charity, you want a charity accountant. If you're a KIC, you want someone that's familiar with KICs. Make sure you know. You can't defer to them. You can't outsource it to them and think job done. They would do it on your behalf. You still need to know whether it's right or not, and so you need to know what you need to do and when you need to do it. Keep records through the year, do your bookkeeping every month, start year end much earlier than you intend to, and make sure you've got your regulator login, and just embrace the numbers. Build into your monthly practice 2 days a month, half looking back, half looking forward. And then I would put the following in your diary as an annual regurgitation. Is it regurgitating? No, I think it's recurring. It's a recurring entry to write the director or trustee report, to prepare the accounts, to get them examined, to get them signed off, to file the accounts and file the annual return. If all the deadlines are in there and you've got some milestones on the way, it should be a pretty smooth process. More reading there. Finance is great. Takes chaos, puts it into order, especially where compliance is concerned. Good luck, onwards and upwards, folks.